Welcome back. With a host of international headwinds out there for the stock market, such as Brexit, the upcoming Fed interest rate decision, and so on, let's see how Paul Moore, the founder of PM Capital, is readying himself to play overseas and also local equities. Paul, thanks for coming on the show.
Thank you.
Now, I know you do specialise, your company does local equities. You focus on overseas. What do you think's going on just locally before we go overseas? What do you think's going on in this market?
Well, locally is a little bit tough because everyone's struggling with what's really happening in the economy. No one's really clear. I suspect it's just going to muddle through, to be honest. And then when you come to the stock market, the banks have come off a long way from their peak prices, which were very inflated valuations, but they're now giving you a dividend yield that on a gross basis probably going to equate to the long-term return out of equity, so it's not too bad. But on the other hand, earnings outlook is pretty hazy. It's, there's pluses, there's minuses. So my instincts tell me that you'll probably just pick up the dividend yield, but that's an acceptable rate of return.
A lot of people used to take term deposits for that same yield.
Well, now you're better off just owning the bank. And as long as there's nothing too drastic out there, as I say, that dividend yield will be a pretty attractive return.
Okay, well, let's get you into the area that you have your greatest comfort, non-Australian areas. Is there anything out there that you worry about that could, as Charlie and I were talking about, why I alluded to stock market crashes, and he said, oh, don't talk about that. Is there anything that you think that could cause a stock market crash in the next year or so?
Oh, look, that's hard. I mean...
Oh, come on. I've got to ask you hard questions. You want soft questions.
I mean, it's the old story. If we knew what was going to happen, we'd all be very, very rich.
Well, subprime, we had a bit of a heads up early in 2007, and we kind of believed that the credit agencies had got it right. And that was, I think, one of the biggest curveballs for people like us, that if the debt rating agencies were saying, we're worried about the subprime, I think the market would have moved a lot quicker. But the fact that they missed it meant, because I know a lot of economists were looking at forward market forward PE, not on the basis that the debt rating agencies are saying, well, there could be a potential worry out there.
Look, to be honest, I think probably what people are maybe missing longer term is that there's now this acceptance of low rates for a long period of time. And the reality is they're the lowest rates in the history of mankind. It's a real anomaly. So my instincts tell me that is not going to stay that way forever. And you know what? 15, 20 years ago, maybe 25 years ago, I can't remember exactly when, monetary authorities were paranoid about inflation and they wanted to break the back of inflation. And back then, interest rates were double digit and no one would have ever thought we could get zero rates.
1987, 88.
And now we have them. So, but now the monetary authorities are paranoid about deflation. And they're doing everything they can to break the back of it. Now, you can't see it at the moment, but if there's one big long-term risk out there, is that eventually they're going to succeed and get what they want. And if you look at price action at the moment, everyone, because they assume rates will stay low, are crowding into toll roads, property, all these assets that have long duration type characteristics and therefore are very sensitive to the discount rate, and that could be a major problem down the track.
So I guess in a perfect world then, if you could get into an infrastructure bond that was paying, say, 5 or 6%, well, that's no problem because you would get that coupon paid to you all the time. That premium will be paid to you all the time. But it's bond funds that you're talking about, aren't you? They're the ones. It's more like the funds that invest in these. They're the ones that could...
Because the equity component is selling at very, very rich multiples, assuming that the bond market's almost right. And the reality is, as I said, it's all-time low in the history of mankind. The bond market is not going to stay here forever. Okay, so is that influencing your selection of companies overseas as well? Because, some people at home are saying, is Paul talking about, say, Transurban and Sydney Airport? I guess you are. Yes.
so they look great, but you said that there are potential traps, particularly if inflation comes in. And it probably means you've got 1 or 2 years, but who knows? The market can sometimes anticipate the future before we want them to do it.
Correct.
So the same is, are you holding the same views when you look at investing in infrastructure type?
Absolutely. We're very wary of any investment that is heavily influenced by a low discount rate, in other words, the bond rate. Because, as I said, I think at some point interest rates will have to normalise. And the flip side is we're looking for companies that in a low inflation, low nominal growth world can deliver strong volume growth and therefore drive earnings. So something like a Visa, which is, I guess the Sydney Harbour Bridge of the payment system. Yeah. And irrespective of what macro environment we're going to have, they're running double-digit volume growth. Yeah. On the other hand, in a low growth world, you want companies that can pay out a lot of their earnings as a dividend and therefore give you that 5, 6, 7% dividend yield, and again in a low bond environment. And the classic case might be their European domestic banks, which at the moment are the most impacted by negative rates and people pushing out earnings recovery. But if you think about longer term, if they've got the ability to pay 6, 7, 8% dividend yields, that's pretty attractive.
But they're not paying it now, but you think the future...
They've just started to. So they're just... The first dividend payments have just started. Yeah. And it looks like they're going to be on 6 or 7 or 8% dividends.
Give us a name of a bank.
Lloyds Bank, ING, Bank of Ireland. They all dominate their market. Yeah. And again, in a low... It's going to kill government bonds with that kind of comparison. That's the crazy thing, because if you're willing to accept in Europe 0, 1% on government bonds, well, a 6 or 7 or 8% dividend yield on what is really a bond proxy, it's pretty attractive.
But to me, I love the sound of this, because if they're able to pay that dividends, obviously their underpinning profits must be starting to improve. And banks, they make their profits out of more confident spending consumers and more confident spending businesses. So in a sense, it's like all the stuff that we've been worried about since the GFC, day by day, week by week, month by month, year by year, things are going to change, and the fact that these institutions are now paying better dividends seems to be a good omen for economies, not for other investment, but for economies.
Yeah, and I think you are seeing that slow improvement. People don't want to believe it because the monetary authorities are still paranoid, and therefore negative rates in Europe. But if you go to places like Spain, they're growing quite strongly. Yeah. So I think if you look underneath the surface, it's just that, again, that just slow progression. And slow earnings recovery. That's fine.
This is the most optimistic you've been on this show since you've ever come on this show.
I can't recall how pessimistic I was last time.
Like most nights, I drive home, think about cutting my wrist.
Well, I think the reality is people just have to accept that returns will be low, nominal returns. Yeah. But when your alternative is 0 or 2%. Again, 5, 6, 7% returns are very, very good. Okay. So then, in that context, the slow recovery in the economies, I think, is okay for us.
So obviously, there's someone like you who trawls the world looking for good companies to invest. At the moment, you're starting to see some opportunities.
There's opportunities and there's also risks. The interesting thing is if you look at the market, because everyone will have noticed it's back to its highs offshore. And there has been a re-rating, but there's some big divergences because, as I mentioned before, those sort of long-duration assets are being priced very expensively, and I'd be very wary of those. But on the other hand, European banks, as I mentioned, are selling at an all-time low historic valuation relative to...
Well, I know there was an argument in America last week that there's an opportunity for a rotation back into financials. Do you agree with that?
It was already occurring. It took a hiccup with
the job numbers.
It'd be interesting to see. I suspect that'll be a bit of an anomaly in itself, and that you might start to see that rotation continue, because there is a big discrepancy in valuations.
Yeah, and rate rises in the US over the next 2 or 3
years. Must be very positive.
Paul, thanks for joining us.
Thank you.
Paul Moore from PM Capital.